live. Good afternoon, Crystal. How are you, ma'am?
I am well, and yourself?
Doing great. Trying out the headphones today. I don't know if you can see them, but
I can.
there you go, doing the headphones.
Okay.
I'm almost like you. I'm going to be a big guy just like you.
You can be a big guy like me. I have to do mine today. So I'll do mine. I'll be back next week with mine.
Okay, cool beans, cool beans. Well,
Yeah.
today's a pretty cool topic. I have conversations about this particular topic with participants, plan sponsors, and advisors, all the same. So I'm really kind of excited to talk about it.
Okay.
The idea of modern portfolio theory versus, top funds inside your retirement plan. So let's get into that. So first of all, let me read your bio, and then we'll jump into the discussion, and we'll go from there. Okay?
Sounds wonderful.
Okay. So, hello everyone. Welcome to On the Patio with Crystal and Jevon. I am Jevon Thomas, a retirement plan advisor, and a licensed retirement plan advisor. And my co-host and friend and colleague Crystal Mitchell is a business coach and consultant. She is the CEO of Mitchell Business Solutions, co-director of Recycling Black Dollars. She's also the co-host of another online radio show called The Business Zone with Crystal and Gilbert. It's a weekly show. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Hey, Crystal, how you doing?
I'm fine, and yourself? And
Doing
hello,
great.
everyone out there. We got a great topic, so we're going to jump right on in it.
Yeah, let's get on in. It's because it's a little bit long, so let's get on in. So the issue is, okay, why can't I have the topmost funds in my retirement plan? And if you're going to judge a plan, don't you want to have the top performing funds, right? I mean, that is kind of why we're here, to make money. And so let's put those top performing funds in the plan and make more money. And the problem with that is, as a retirement plan advisor, most of us live and breathe by the concept of modern portfolio theory. And a couple of talking points when we start talking about modern portfolio theory. And one is, which you probably won't find anywhere else, but what I like to say, one of my personal points about modern portfolio theory is that it really works for people that are going to be in the market for a long time. And so most people say this is a retirement plan, I'm a long-term investor, but I have to put a caveat on that, and I do with everybody that I talk to about their plan. So I say straight up, hey, you're going to be in the market for a considerable amount of time. Let's call that 5, 10 years, 7 years, 10 years, even better. However, you're going to take advantage of market downturns, right? So when the market goes down, i.e. when your fund goes down, you're hopefully going to buy that cheap, and when the market comes back up, that's when you profit from your windfall. So the example that I always give folks is, would you rather buy a house for $100,000 that goes up to $200,000, or a house for $50,000 that goes up to $200,000?
Mm.
Right? So since we're in a long-term thing, we want to buy as cheap as possible and sell for as much as possible. Right?
Okay.
So market downturns are not a bad thing. They're an opportunity for those of us that don't have huge amounts of money, for those of us that are going to use what we call dollar cost averaging, we're putting the money in every time we get paid. For those of us that are in the market for a long time, we can profit from downturns by buying cheap. And of course, selling high on the other end. Makes sense?
Okay.
So that's one of the big things about modern portfolio theory, long-term investors. Another big thing, which is one of my favorites, is diversification beats picking winners. And that's tough, because a lot of people don't realize that having a well-diversified portfolio, and we have this discussion with plan sponsors all the time, having a well-diversified portfolio protects you from the situation we had in 2001. Remember when the market tanked, right? Remember the dot-com bubble, right?
Mm-hmm.
Right. So having a well-diversified portfolio can protect you from that. Not saying that you don't want to, take advantage of the upturn, but
Mhm.
we definitely want to make sure that we're not getting swept up in that, right? And we're
Okay.
not that we're not giving away our opportunities to buy cheap, right? Because we still want to do that. Okay.
Right.
The other thing is diversification only really works when we have correlation, right? So if everything is correlated the same way, this isn't diversification. We need to have things that are going in different directions all the time. So we're always winning. I'm going to
Okay.
say we're always winning. Some folks are going to say, well, you're always losing too. Well, that may be, but we're always winning, right? Because we're always buying cheap.
Yeah.
And then, of course, the last one is, you've seen it on every ad for any particular investment. Past performance is not indicative of future performance. Right? So with those three in mind,
Mhm.
we just have to come up and say that portfolios win, not individual funds.
Okay.
So as a retirement plan advisor, I talk to people every day about let's make sure your portfolio is well advanced or well diversified. Right?
Mhm.
Make sure it's well diversified. Let's make sure that you've got the right mix of stocks and bonds that's for you, right? So you got to take that that questionnaire, and a lot of people don't want to do it. I'm not exactly sure why, because they only take 10 minutes, and just about everybody has one, and you can do it online, right?
Right.
The chances that you're going to make a mistake with a financial advisor there helping you, pretty slim,
Mm.
right? Pretty slim. One of the things that is very special about 401ks, 403bs, IRAs, company-sponsored retirement plans,
Mhm.
is that the investments that you have are actually appropriate for a retirement plan. So sometimes my clients will say to me, my participants will say to me, okay, Jay, I'm going to move out of this plan. I'm going to leave this job, right? I'm going to go someplace else. Can I leave these assets here? Well, if you have more than 7,000, you can leave it there. Is that a good thing to do? And the answer to that question is yes and no. And we're kind of going off on a side point, but it's yes and no. And one of the reasons why I say yes, it's a good thing to do is because there are protections in place to protect you as a participant. You're going to make sure that you don't have funds that are extremely aggressive in ways that may not be appropriate for you. Right? So the chances that you're going to have a fund of gold widgets or gold, what do you call them, nuggets, gold nuggets, gold things
Nuggets.
like that, gold
Mhm.
nuggets, pretty slim. You're going to be able to invest in that in the retirement plan. You're not going to have an oil and gas fund, right? So these extremely aggressive funds that are extremely volatile, not going to have those in a 401k plan. Also, the chances that some advisor, other than me, some advisor who's going to try to make a quick buck off of you, you're not going to have to deal with him. So you have some protections in the plan, right? However, outside of that plan, depending on who you are, those may be hindrances, right? You may, outside of that, you may want to go a little bit more off the beaten trail, and that's fine outside your plan. And that's what I tell folks. Outside the plan, you can get jiggy with it. Inside the plan, we want to stick to the straight and narrow. A well-diversified portfolio, right mix of stocks and bonds. So when people say to me, my portfolio is not doing anything, and I have to say to them, that's not necessarily true, right? Because if your portfolio, if you're still putting money in your portfolio, and that's how these things work, they don't work where you buy and hold and don't add to them. They're designed for regular people that put money in on a regular basis. So if you're putting money in on a regular basis and part of your portfolio is going up and part of your portfolio is going down, you're probably doing it right.
Mm.
Right. If all of your portfolio is going in one particular direction, you might want to take a look and say, am I well diversified? Right? Am I really doing this the right way? Right? So It's almost like your retirement plan is one tool in your toolbox for retirement. Your other plan could be the real estate that you own, the investments that you have outside there, the your kids taking care of you, whatever it is. So the retirement plan is just one tool. Okay, so things that can kind of mess you up with regard to why this is a top fund, right? Number one, or why a top fund may not be good for you. Let's talk about it that way.
Okay.
Right, so, just because it's a top fund doesn't mean that there's no risk associated with that. You know, we could say that gold, for example, is a great thing to put in your fund because it's going up like leaps and bounds. It's also extremely volatile and it moves with the tax rate, so not really suitable for a retirement plan. So I've had some gold and precious metals funds. I've never put one in a retirement plan. It's just too volatile. Okay. Sometimes you'll see a large cap fund, but that's not because, you see a large cap fund is doing well, let's say. And that's not because the management is all that in a bag of chips. That's a financial term, but all that in a bag of chips.
A bag of chips.
A bag of chips, yes. You know, sometimes I have to throw those financial terms in there so people know that I know what I'm talking about.
Understand financial terms.
Exactly. A bag of chips. But, anyway, so sometimes the reason that fund is doing so well is they've made a deal with the record keepers and perhaps some large advisor houses where they're going to get that fund cheap, and therefore, even though it's not performing all that well, it's not so expensive, so it's really not a hot fund, right? It's just that the distribution was so inexpensive, right? Okay, so so things like top rated, best in class, they don't necessarily always go with modern portfolio theory, which is based around different asset classes, different levels of a diverse amount or diverse type of funds, group of funds in the platform, and making sure that things are not correlated so they don't always go in the same direction, because we want to buy as much as we can of different stuff, right? So we want all different kinds of eggs in our basket. We don't want to put all our eggs in one place because you never know when that's going to crash. We saw that in 2001. Some of us say we saw that in 2008, right? So we know what happens when you pick a winner and that's all you got. See what I mean?
Yeah.
Okay. And then, of course, the most important one, I think, is past performance does not guarantee future performance. So just because it did great last year doesn't mean that it's going to do great this year, and certainly not 8 years from now. So often when I'm looking at a fund lineup, and I just did this the other day, and I see that, we have a fund here that's not performing well. How long has it not been performing well? Has it not been performing well for the last 2 years? I don't know if we should move that. Has it not been performing well for the last 12 years? All right, well, okay. Maybe that's not a great fund, right? Has it not been performing well for the last 6 months? Okay. That might be a good thing. Small caps could be out of favor. Large cap value funds could be not doing so well. Defensive stocks may not be performing as well. It may not be the top of the heap, right? The best performing fund in that category today. But that doesn't mean that it's not a great fund, and that doesn't mean there aren't going to be some opportunities for you to buy that fund and get a very nice return when it does come back into favor. Right? Make sense?
Yeah. I might interject. It's interesting. My nephew, we were having these conversations this weekend, and
this conversation?
Well, kind of this conversation as far as he's a Gen Z. and understanding, the whole idea of the stock market, stocks, and performance of stocks. And of course, young people now, they feel that, and this is a conversation that we really had, was that crypto is way for them. And I kept saying to him, I said, but that you couldn't have that in your retirement plan because it's too volatile. It, first of all, it's not backed on anything. It's not a company just producing something that you can
Mm-hmm.
see something else.
Yep.
For me, that's important. I need to see some financial statements that says that this and this is happening. And so, but they're kind of convinced a population because nobody's really having those conversations with them, right? And so
Mm-hmm.
they're convinced that you know they're that a 401k is not the way for them because of the fact that they feel the stock market, as he told me, and I was telling him, when I think about what's going on out there, there are a number of advisors that have been doing this for a very long time, and they understand the whole they hold the whole landscape of financial of stocks and mutual funds and things of that nature. And I mentioned Warren Buffett was one that I think he is for me he's my guru, right? Because he's been around since 19 something or another, and his business is based on tangible products, right? He don't do anything that's not tangible things like it's the everyday human being he uses every single day. That's what his business, that's what uh, his um, philosophies are. And so he says, "Oh, he's old school. None of that matters anymore." Right? Yeah, no. I mean, money is money, and investments are investments, and they've been around for a long time. They perform differently, and you really can't just lump it all into one big pot like that, right? You have to look at them individually. You have to be advised by people that are studying this every single day. But and that made me think, that's a market that's just left out, obviously, that don't get this and think that, okay, this new digital um, market is what's going to be the future of,
Oh, I didn't quite understand that. Can you say that
meaning
again?
that a lot of them are under the impression that money is going away and that we're only going to be using tangible, touchable money is going to go away, and we're only going to be using digital currency.
All right.
Um,
All right.
and I said no, because you have to be diverse. You just can't put all your eggs in this one basket and assume that it's going to. This is it. This is how I'm going to manage everything. Nothing's like that. Everything is kind of diversified, and so. But that was the conversation we were having. Okay,
Interesting.
I'm getting him tons of books and investing in. From old school and new school. I found some young Gen Zs that talk just like Warren Buffett.
Hmm.
And
You
I'll
know,
be
I have two things to say about that. One is most of us don't understand the general stock market. Most of
yeah.
us have no idea. There's the stock thing. What is that? And it goes up and down. How does it go up and down? Why is it going up and down? We don't understand that. Most of us don't understand that.
Mm-hmm.
We don't have the concept of a marketplace, right? So most of us don't understand that if you want it, you're going to pay more for it than if you don't want it. And
Mm-hmm.
if you don't want it, you're going to sell it for as much as you can get for it, right? And so that
Mm-hmm.
is the market. And that's
Mm-hmm.
what we're dealing with when we're talking about the stock market. If you want it, you buy it. If you don't want it, you sell it. And where
Mm-hmm.
those things come together is the market. And from that, we get quote unquote value and all these other terms with regard to the value of the stock. And if you do something great to your product and that makes more people want it, boom. So it's a market.
Right.
Crypto's a market, is in that market as well. And so if you can handle that volatility, that's on you. Do your thing. Right? I'm not going to
Mm-hmm.
tell you to somebody don't buy crypto. If they want to
Mm-hmm.
do it and they can handle the volatility, go ahead. I don't want to hear about oh, the market isn't real, oh, the market doesn't do this, oh, the market's made out of that. No, stop. It's a market. You can participate in it or not.
Mhm.
You know, and you take a look at real estate. That's been on a tear these last few years.
Mhm.
Fine, if that's where you want to be, fine. If you're like my ex and you're saying to yourself, all of this is crazy, I don't want to be in it at all, you can put $250,000 into a bank that's FDIC insured. Do
Right.
that 10 or 20 times throughout your life.
Mhm.
Cool. Don't take any risk and have the money, right?
Mhm. Mhm.
So there's a lot of ways to skin a cat. But for most of us, we need to use the market because we can start small. And the last thing I would say about that is there's an expression that goes, lots of people want to do what you do, but they don't want to do what you did to get there.
Mhm.
Right? So,
That's a good one.
right? So,
Yeah.
we got a lot of people saying, "Oh, I want to be like Warren Buffett. I want to have millions of dollars, and I want to spend that on charity and rip off my secretary and do all that kind of stuff." But not too many people want to start where Warren Buffett started.
Right.
Get the education, make the mistakes,
Yeah.
find a system that works, and stick with it for as long as he has. Not too many people want to do that.
Right.
So, it's easy to look at the product and say, oh, that was very effective. It's pretty tough to look at how he got there. And he didn't
Right.
get there all at once. I mean, he didn't get
No.
there back when he started and all of a sudden he made $4, $5, $50 million. That's not the way that worked.
Mhm. No. No.
So you have to take that into account, I think. So that's my preaching. I'm not
Okay.
going to do any more preaching. I will read your bio one more time. Let's
Oh.
see. Well, everyone, this is Jevon Thomas. Thank you for joining me. I'd like to let you know who my friend and colleague Crystal Mitchell is. She is a business coach and consultant. She's the CEO of Mitchell Business Solutions. She's a co-director of Recycling Black Dollars, a co-host of The Business Zone with Crystal and Gilbert. That's another online weekly radio show you should check out. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, which is really cool, and last but not least, a QuickBooks Pro Advisor financial strategist. Crystal, we got a few minutes left. Do you want to have the last word?
Yes. So, again, and this is a great topic because, again, like I said, there are populations out there that just don't get this stuff, right? They don't understand, and based on that, because of that, they make or they don't make some very some decisions based upon their lack of knowledge, and which can be very harmful when you really need this, and that's when you're retiring. So, or as we are in right now, a very volatile time in our country when we don't know what tomorrow brings. So I think the more knowledge and the more information and education that you acquire, the better you'll be equipped at making the right decisions for your financial portfolio for the now and the future. And so I think it's really important to research this out there. We've got everything that's at our Google fingertips or our AI fingertips now. There is nothing you cannot learn because it's there. It's out there. So I want to say that, and I want to tell everyone to have a happy Thanksgiving and be safe out there this coming week.
Great. Well, thank you for that, and I can only second that. Have a happy Thanksgiving. We'll see you probably next week or so. All right.
Yeah, in December.
In December. We'll see you in
In
December.
December.
In December. All right. Take care. Thank you, Chris.
All right. Bye-bye, everyone.